The greatest threat to the economy of the United States isn't the much discussed AI bubble, nor is it China or even the figure sitting in the White House. It's a condition that's far more mundane, which you might not have heard about unless you've delved deeply into financial topics. And that's precisely why it's flying under the radar. If you've been curious about why mortgage rates remain stubbornly high, why stock prices can become erratic every few months, or why the Federal Reserve discusses the prospect of rate cuts while financial conditions seem to tighten, look no further than Japan, particularly at the least exciting asset imaginable: Japanese government bonds. This country, often associated with American fans of manga and anime, has quietly been a stabilizing force in the global financial landscape for 3 decades. However, that stability is beginning to fray. To grasp the significance of Japan's role, we need to journey back to the early 1990s. In 1992, Japan's real estate bubble collapsed, leading to a massive drop in stock values and plunging the nation into what has since been dubbed the lost decades. For nearly 30 years, Japan experienced stagnant financial growth. No inflation, no salary increases, nothing but a prolonged economic freeze. In response, the Bank of Japan did what all central banks do in desperate situations. They slashed interest rates to zero, and then even lower. When those measures proved insufficient, they implemented a strategy known as yield curve control. It may sound ominous, but essentially it meant that the government would keep long-term bond yields capped, regardless of market dynamics. For years, Japanese government bonds offered virtually no returns, creating significant challenges for domestic investors. Imagine you're a Japanese life insurance company, pension fund, or bank managing a $1 billion investment portfolio, and your domestic bonds yield a flat zero. This scenario leaves you with two major choices: accept zero returns on your capital or seek opportunities abroad. Most chose the latter. Consequently, Japan embarked on a long-term global investment spree, becoming the largest foreign holder of United States Treasuries, a major buyer of U.S. mortgage-backed securities, and the world's largest net creditor nation, effectively acting as a global ATM. This trend wasn't merely due to a love for American investments. It was a sensible financial decision. Let's consider the example of Bob. He wants to invest wisely, so he takes out a loan in yen at almost no interest rate. Bob then converts that yen into dollars to purchase U.S. Treasuries that yield 4%. After accounting for hedging costs and fees, he pockets the difference. This process became known as the yen carry trade. Investors borrowed in yen at these low rates, then invested in foreign assets offering higher returns. In this environment, investors weren't just limited to treasuries. They also targeted tech stocks, real estate, and emerging markets. Virtually any investment with a pulse that promised more than zero return was fair game. As a result, the yen carry trade turned into a massive driver of global liquidity, with some estimates placing it in the trillions. It was as if global markets were operating on Japanese Wi-Fi. However, the entire setup hinged on a crucial assumption: that Japanese yields would remain at rock-bottom levels indefinitely. This assumption shattered in 2024 when the Bank of Japan abandoned its yield curve control and raised interest rates for the first time in 17 years. Shortly thereafter, the S&P 500 saw a 6% decline, while the Nikkei 225 plummeted over 12% in a single day, marking its sharpest drop since 1987. This clearly indicated that the markets were rattled. As Japanese yields increase, two significant changes occur. Borrowing in yen becomes pricier, and so does hedging against currency risks. Suddenly, that 4% U.S. Treasury Bob was interested in no longer looks appealing. This signaled the decline of the yen carry trade. As calculations shifted, no longer an assured profit, the trade became less enticing. As the financial landscape evolved, the capital that had previously flowed out of Japan began to make its way back home, a phenomenon referred to as repatriation. This repatriation poses a significant challenge for global markets today, revealing an unsettling reality. The most affordable source of global liquidity for the last 30 years is no longer affordable. This shift matters greatly. Japan was not merely an arbitrary buyer of U.S. debt. They were consistent, price-insensitive purchasers of long-term treasuries. The yields on these treasuries aren't dictated by the Federal Reserve. They are primarily shaped by supply and demand dynamics. While investors often focus on short-term rates influenced by the Fed, the long end of the yield curve is more impacted by investor behavior and preferences. Moreover, considering that the United States is grappling with annual deficits in the trillions, even a minor demand shift can have substantial consequences. The Treasury must issue considerable new debt each year just to keep the economy running, and as this debt continues to accumulate, someone must absorb it. Japan has traditionally played a crucial role in this absorption. Before I elaborate on the implications if Japan retreats from this role, let's take a moment to acknowledge the resources that aid in organizing thoughts and converting them into structured arguments. Japan could significantly impact our economy. If one of the largest historical purchasers of United States Treasuries halts its buying, yields will need to increase to attract new investors. This illustrates the principle of supply and demand shaping the long-term bond yields. Such a scenario could lead to a situation where the Federal Reserve reduces the federal funds rate, causing short-term yields to decrease while long-term yields remain high. This dynamic results in what is known as a steepening yield curve. When long-term rates refuse to budge, it transitions from just a bond market issue to a broader, all-encompassing financial concern. Analysts often use long-term yields as a baseline to discount cash flows when evaluating stocks. As these long-term yields stay elevated, the present value of future earnings in these evaluations diminishes, leading to a downturn in valuations and lower trading multiples for stocks. Consequently, although earnings may remain stable, the prices that investors are willing to pay for those earnings may vary. This explains the market's potential instability even in seemingly calm headline conditions. The influence of the 10-year Treasury yield extends beyond stocks. This figure is not merely a statistic but a crucial determinant in the pricing of money, forming the basis for almost every asset valuation. Mortgage rates serve as another pertinent example. Just like stock valuations, mortgage rates closely align with long-term Treasury yields. Therefore, unless the 10-year yield drops substantially, mortgage rates won't simply revert to 3%. The Federal Reserve may lower the federal funds rate as much as they wish. However, if global demand for treasuries diminishes, the long end of the yield curve remains stubbornly high. This high yield results in sustained, elevated mortgage rates, persistent housing affordability issues, muted refinancing activities, and a slowdown in home transactions. The ramifications extend to corporate credit as well. Reflecting back on the years 2020 and 2021, when capital was readily available and interest rates were low, companies issued debt as if it were a major sale event. Access to inexpensive financing led to increased deal flow, soaring valuations, and heightened activity levels, underscoring that credit is essential to corporate dynamics. In contrast, if borrowing costs remain high, we witness a decline in risk appetite, a slowdown in growth, and a tightening of capital. This is a crucial takeaway from this discussion. For the past 30 years, the United States has gained significantly from being the primary beneficiary of the world's largest carry trade, which is now unwinding. As Ray Dalio observed, the bond market serves as the backbone of all financial markets, guiding the interest rates that determine asset returns. Right now, we are witnessing a tangible shift reshaping the underpinnings of the bond markets, and conventional financial media often overlooks this. The reason is clear. These topics lack the sensationalism that captures audiences and trend on social media. The complex discussions surrounding the cross-currency carry trade and Japanese institutions reallocating capital demand patience, insight, and a level of thoughtfulness that is frequently overshadowed by more sensational information. Instead, audiences are drawn to discussions around inflation, artificial intelligence, and the latest trends in technology stocks. This leads to oversimplified narratives suggesting that a single Federal Reserve rate cut will alleviate all financial woes. A misleading notion. The belief that liquidity is guaranteed and that there will always be buyers for our debt is not necessarily true. What occurs if they do not show up? What if the largest foreign holder of U.S. Treasuries decides to withdraw? This would result in a tightening of global liquidity, which serves as the lifeblood of markets. A tighter liquidity scenario drives changes in the cost of money across the board. As we discussed, this influences aspects from stock valuations to mortgage rates and corporate credit. This is the purpose of this channel, to highlight the real issues that matter and which traditional financial media often neglect due to their lack of clickworthiness. If you are keen on understanding the actual happenings within financial markets, please hit subscribe and activate notifications, as I will be bringing you insights that the mainstream financial media won't cover. The true risks in markets tend to lurk beneath the surface. They are rarely the loud ones, as those get accounted for in pricing. Thank you for watching. Don't forget to subscribe to Billy Finance, and I look forward to your comments.